I love receiving dividends and earning passive income. So Scotiabank actually paid us out a $19 dividend. And then I used that money and I reinvested it right back into the company. So with our $19 dividend, which is the highest dividend I've earned in my portfolio since starting it, I bought about a quarter of a share of Scotiabank. And this is just going to continue. I'm just going to continue to reinvest the dividends in my Canadian banks, and I'm just going to keep increasing my income and increasing my ownership in these very predictable cash flow generative businesses that continue to grow and reliably grow and will pay me income potentially for the rest of my life. The markets have also been pretty kind this week. So generally, a lot of companies are hitting their metrics. I have a lot of different earnings reports to get into in the update, but in my two accounts here, I have the RRSP for my retirement account. I only have the one stock, so only Starbucks here, so we're in the green by 3.5%. And for the TFSA, we are almost even. We're only down $30, so pretty much flat in this portfolio. But considering that the S&P 500 and the Nasdaq, basically every index has very vastly underperformed this year and done horrible, we're doing all right. So please follow along with the channel. So hit subscribe, hit the like button, and I'm gonna get into the portfolio update. In the last day on Thursday, our portfolio went up 1% or $109.26. For the week, we're down $17, so basically flat, not much change. The past month, we're up 5% overall, or up $730. Past 3 months, we're still down 4% or $564. And for the year, we're down minus 3%. So not too bad if you compare how down the rest of the market has been. That's pretty good. And basically flat all time. So we're just down $30, basically even. So I think we're doing pretty well relative to the rest of the market. And when the market rebounds, our portfolio will rise with it. And let's get into the portfolio. So Apple actually announced their earnings, and they showed pretty good growth. So this position's doing fairly well. It's up 9.4%, and it actually traded even higher after hours after the earnings report. And Apple did quite well on their revenue, so they beat the expectations, and they actually have very good looking guidance. They say that they expect even faster growth to come in the future. So this is great. And the revenue, they beat by 2%. iPhone revenue is up. Services went up 12%. So you can think of that their iCloud business, their Apple Music, their Apple Fitness, their iCloud, Apple TV. That is just going to be a consistent, reliable source of income that's just going to continue to increase. So very good over there. The other products would be like their wearables, like the AirPods and the watches. So a little underperforming here, but overall their top line revenue and even their profit margins increased. And in a time of really high inflation and supply chain issues, Apple's proving, that they are definitely a very quality business that will not underperform, and they won't let you down even when times are tough. Like a lot of businesses had their profit margins sink, and Apple is not one of them. So that's why I think the stock is worth paying a little bit more for. This company's special, and the brand value is definitely there. And one thing I just want to focus on is that the Mac revenue is down 10%. Now that's fairly normal because the PC sales, at least for the industry as a whole, is actually in a 15% decline year over year. So the fact that they only lost 10% of their MAC revenue is actually beating the industry. So it looks bad, but if you compare it to the overall industry, they're outperforming it. So I'm very happy with Apple, and I'm not surprised that their earnings report in general, their top line and their bottom line revenue were great. And they expect that the next quarter will be even better. They're going to be launching an iPhone 14. Just like every year, they'll launch a new iPhone that people will want to buy. Moving along with the portfolio, I've added a new position, although I've been in this one before, so it's Alimentation Couchstar. So I've owned this in the past. I've sold it to purchase Suncor, which I sold for a great profit, so I had no regrets selling it. It's actually run up a bit since I bought these first 2 shares, but essentially a global convenience store brand that has gas stations attached to it. They have like 14,000 convenience stores all over the world, and they have an opportunity to convert those fuel stations into charging stations, and they can just charge people very, very high amounts of money to go into their convenience store while they're waiting for their electric vehicles to charge. So I think they have a good future, good consumer defensive business in Canada, and I believe it's trading at a pretty good valuation. I assume that this business can grow at least, maybe 6-7% annually. Analysts think it can grow at 10%. So I priced the stock at about $65. So I think it's pretty undervalued, and I'm shooting for a 13% return with that assumption. So I just want to beat the market by a couple percentage points, not a lot. So I think ATD is a great buy right now. And I think it's a better value than Loblaws right now, because I used to be in Loblaws, but ATD is growing much, much faster than Loblaws, and they're not limited to one region of growth, which is just Canada. ATD can grow all over the world, so their total addressable market is much, much bigger than Loblaws, and the valuation and the PE is cheaper, so it's just a better investment in my mind. I will be buying it. I'll keep adding, a share here and there all the way up to 65. After that, I'd have to evaluate my other opportunities, but I do want to get a consumer defensive back in my portfolio, and this is one I want to keep. There's got to be a reason I keep coming back to this stock. Is just I really like this company a lot. I'm very comfortable with the company. I just looked into the numbers again, and I figured, why not? Let's get back into the position. Because I sold out my Loblaws. And with Aritzia, I just added one more share, so going from 12 to 13 shares, so we're up 6.42%. This actually declined all the way down to $36 after Walmart reported some pretty terrible forward-looking guidance that their profit margins were going to go down severely because people were focusing on essentials like food, like groceries, over clothing and electronics, which is their higher margin products. And as a result, all of retail went down across the board. Now, I don't think Ritzy is really affected by this because this is luxury clothing. And on the previous earnings call, the CEO was asked about, how they feel about an upcoming recession should that happen. And they said, we may lose a few customers at the low end, but they don't anticipate that to really affect their overall growth because they're attracting a higher end clientele, and they're not as price sensitive. They're not deterred by recessions, and luxury brands typically hold up better during recessions. So that's why I'm comfortable holding this business, regardless of the economic environment that we're in, because I believe that they can grow at a very, very high rate for many, many years to come and compound and multiply our money. So very excited with this opportunity. I'll be looking to continue adding shares. I have a price target of about $50 for the stock. So anything under that, I think, is a decent buy, at least in my opinion. Do your own research. Don't trust any random person on the internet about, what stock to buy. You have to really understand all the businesses you're buying, and, if they go down or they go up, you need to know what you're going to do. You can't seek validation from others, especially with stocks, because, everyone has an opinion, whether, it's right or wrong. And Alibaba, no news here. It's about where it's been. Brookfield has risen up a little bit, so they've climbed out of the 50s up into the low 60s. I wish I could have gotten more in the low 50s, but I did think Ritzy was my best opportunity, so that's why I didn't do that. Scotiabank, again, we reinvested that dividend, so we're just increasing that. Enbridge, our ENS position, has been doing very, very well. It's up 9%, and just giving us an over 10% annual yield. So the boring pipeline company is one of our best performers. So sometimes, you don't need an interesting business to do well. Just stick with boring, predictable businesses that can return value to you, the shareholder, and you'll do well. So very happy with Enbridge. Ethereum has climbed up a little bit, so we're slowly climbing out of this abyss. Still down 48%, but again, less than 1% of our portfolio. Not really worried about it. This is kind of, just kind of a fun investment. I'm not taking this one too seriously, so very little of the portfolio is actually in this, and this just pays us a monthly income, so it kind of fits my theme of hitting a passive income, but I don't mind stocks that don't pay dividends, as long as I believe that they will grow at high rates. So Google, or Alphabet, the parent company that owns Google, actually shared their earnings. So Google actually increased revenues by 13% year over year. And if we are not accounting for the currency exchange issues, which the global currencies have underperformed the U.S. dollar, and Google is a global business, their growth actually would have been 16%. So it's pretty fast growth for such a large company. And of course, we see their operating margins declined 31% to 28%. But again, it's been a tough time for the ads business in general. So overall, I'm pretty happy with this earnings report, especially compared to other companies such as Meta, who have actually declined their revenues for ads by 1%. And it seems like their business is shrinking and deteriorating. And sometimes stocks are cheap for a reason. And I just don't like Facebook's, or Meta, whatever they want to call themselves. I don't like their business, and nobody uses Facebook anymore, and teens are not really using Instagram. They're flocking to TikTok. So the trends are not with them, and the youth are not with them. So I don't see a bright future for that business overall. With Intel, there's good news and there's bad news.
Take this object, but beware, it carries a terrible curse.
Ooh, that's bad.
But it comes with a free Frogut.
That's good.
The Frogut is also cursed.
That's bad.
So let's start with the bad news first. I always like to look at the bad news first so we can be happy about the good news. So revenue is down for Intel. Gross margins are down. Now, one thing to keep in mind is that, Intel is building chip-making facilities, and they're spending a lot of money on R&D and mergers and acquisitions. So this actually increased 17%. This line is very important to me because my entire theory for investing into Intel is I'm investing for the company it'll be in 2025 and 2026, not the company it is right now. And because they're investing so heavily to be very competitive in their markets, CPUs, GPUs everywhere, and they're building these chip making plants, and they're making like smart acquisitions that can help not only grow their business, but compete in a very, very competitive semiconductor industry. So because of that, I don't mind that their margins are down. I know this is only because they're spending billions and billions of dollars in capital expenditures to make these chip making plants. Now, with all that doom and gloom out of the way, CHIPS Act was cleared by Congress. So this is a piece of legislation that is going to grant $52 billion in subsidies. $20 billion is going to Intel directly. So this is really going to help them out to build these chip-making plants. And they've already signed, 6 out of the 10 major chip designers in the industry. They have a deal with MediaTek, so they're very big, mostly manufacture in Taiwan, but now they want some manufacturing in the States. So this is a great, not only for Intel, but it'll help create some jobs in the U.S. economy, and it'll also help with national security because there's probably some military chips that they probably don't want to make overseas. and also supply chain issues, were they to ever happen again in the future. Because we have some manufacturing in the United States, the shortage of semiconductors should never happen again, theoretically. So all good things for Intel, and I think a great thing for North American consumers as well. And Microsoft also reported their earnings, and they also grew their revenues. So for the earnings report from Microsoft, revenues were up 12%. If not for the the global currencies doing so horrible, and the euro being about on par or lower than the US dollar, they would have grown 16%. Operating income was up 14%. Net income up 7%. So, despite all this foreign currency, which is kind of out of Microsoft's control because they're a global business, they earn dollars and different currencies all over the world, they are impacted when the global currencies are underperforming. Unfortunately, so all those European dollars not as valuable, and it hurt the bottom line. So they only really grew revenue by 12%, but that's still very, very fast overall. And their Microsoft Cloud revenue was $25 billion, up 28% year over year, and my LinkedIn revenue was up 26%. So if you weren't aware, Microsoft actually owns LinkedIn, and they make money on it through advertisements. 29% actually, if not for the foreign currency, the global currency is underperforming so much. Intelligent Cloud was up 20%. A lot of these segments are growing very, very quickly. Personal computing was up 2%. If we looked at Microsoft Azure, which is their cloud services, that grew 40%. If not for the currency issues, it grew 46%. Absolute incredible growth. You can just see like pretty much every segment that they had, outside of a couple, all continue to grow. So Microsoft is a very high quality company, very consistent, and despite its large size, it can still continue to grow a lot more because it is a global business. They have an extreme competitive advantage. It's really hard to get away from using Microsoft Windows and Microsoft Office, especially when they have contracts tied up with people for years and years to come, and they have their cloud services, which is growing faster than any other cloud service in the entire world. That includes Google and Amazon. And Powercorp of Canada is going to be paying us a dividend tomorrow, actually on the 29th, so we're going to be getting around $12 from this position. I'll probably reinvest that back into TD Bank, just because I've already purchased a share of Powercorp, so we've kind of already reinvested the dividend, and I don't really want to have fractionals in Powercorp. I'd rather put that towards the banks because they're a little bit harder. It's a little bit harder to come up with $80 for a share. Smart Centers has performed very well, especially when real estate has done very, very poorly. The fact that this one is so defensive and is anchored by steady businesses like Walmart's, it has not declined nearly as much as the rest of the real estate market. So very happy with this choice overall, and I could definitely see myself adding, one share a month, maybe a little bit more if it declines, but it's actually held on so well. I may be looking to add other positions for real estate because there are other sectors like industrials and apartments that have gotten hit very, very hard, while Smart Centers held up very well, just paying us that monthly income. It's yielding over 6.5%. So great business, and they're building apartments and going to be integrating it with their plazas. So very good future prospects for this one. And TELUS is back into the green, so just a solid company, just keeps paying out that growing dividend. Love them. And as we all knew with the Rogers outage that affected a lot of Canadians, the telecom industry is very, very important because, when you don't have internet or phone service, all of a sudden you realize how important and vital it is. So this is going to be a steady utility play basically for years and years to come. TD Bank is going to pay us a dividend of about $15 or so they're going to be paying us on the end of the month. So going to be looking forward to that, going to reinvest that dividend. And that wraps up this week's update. So please like the video and subscribe to the channel if you've watched the entire video. And in the comments section below, just let me know like how you're doing, how your portfolio did this week, how it held up. All right, have a good one, everybody.